Most traders fail because they don't understand market structure clearly. They know every indicators and PDRAs, but the final result is... After watching this video, you'll understand every little thing about market structure. Welcome to Learn Price. In this video, I'm gonna explain market structure as clearly as even a 9-year-old kid can understand. I'll break down what is market structure, how to identify trends, lower time frame versus higher time frame trends, and finally, how to mix them with other ICT concepts. Get your notebook and write down everything I say. Price doesn't move straight up or straight down. It moves in steps. The market goes up, pulls back, then goes up again. Or down, pulls back, then goes down again. That's how the market moves. If someone don't understand the market structure, they better leave trading and find another job. Because without knowing a market structure, you can't stay on the game. In order to understand the market structure, you have to know about trends. There are 3 trends in the market: uptrend, downtrend, and sideways. Uptrend is when price continues creating higher highs and higher lows. As you can see here, there's a high right here and there's a low here. Then price breaks this high and create a higher high. A higher high means price's new high is higher than the last high. And higher low means price's new low is higher than the old low. When price breaks the last high and create a higher high, that's a break of structure. And as you can see, price pulls back, create another high low and breaks structure. That means higher high. Then price starts consolidation. It doesn't break either the low or the high. In this case, this trend is sideways. Then when price breaks the last lower high, we can say that's a market structure shift. A market structure shift from an uptrend to a downtrend. Let's see in the bearish scenario. There's a high right here and a low here. Then price breaks this low and creates a lower low. A lower low means price's new low is lower than the old low. And lower high means price's new high is lower than the old high. And right here, price pulls back but can displace over the last high. Instead, creates another low low. Then there's a consolidation here. And finally, price breaks our last high and starts creating higher highs and higher lows. This is a market structure shift from downtrend to an uptrend. Let me tell you one harsh truth. In reality, price doesn't create this kind of perfect lines. Sometimes it will be messy. So if you struggle with finding the trend in a live chart, that's not because you don't understand the market structure. That's just a matter of experience. So you don't have to watch another video about market structure. You just have to face the charts. I promise you. If you just sit 1 or 2 hours a day on the chart, within a week, you'll start seeing the trends in seconds or minutes. Because as I said, that's just a matter of experience. Let's look at this on the chart. As you can see right here, there's a low and there's a high. And then price creates a higher low and then breaks its structure and creates a higher high pulls back, creates a higher low, and then break its structure and create another higher high, and then pulls back, higher low, and then breaks its structure, higher high, and then pull back and makes higher low, but this time price can displace over this high. Instead, price shifts its structure and breaks our last higher low and make lower low, and then price go up but still can displace over this high. This time we confirm that the market is about to shift its structure from an uptrend to a downtrend. Price continue its downtrend. As you can see, after price shifting its structure, price was moving downward aggressively. Let's see another example. Here we are with a bearish example. As you can see here, there's a low and there's a high. Then price creates a lower low, and then pulls back and create a lower high, and then breaks structure again and creates a lower low, and then pulls back, a lower high, and then breaks its structure and creates a lower low, and price creates a lower high again, but this time price can't create another lower low. This means sellers are losing their strength and buyers are coming to the market. And this move confirms as the trend shifts. After this, price makes a higher high and then a higher low, and then continues its trend. It's an uptrend. As you can see here, price completely shift to an uptrend and continue moving. Now that we understand market structure and trends, it's time to see how the higher time frame and lower time frame connect. Most traders completely miss this and it costs them trades. Here's something most traders don't realize. A trend on a higher time frame is made of many smaller trends on the lower time frame. Think about it. What looks like one big bullish leg on a 1 hour chart is actually several smaller trends on a 5-minute chart. Each one of those smaller pushes and pullbacks is a full trend on a lower time frame. So if you only watch the lower time frame, it might look like the trend is ending, but on the higher time frame, it's just one leg. Now here's where beginners get trapped. A market structure shift on a lower time frame doesn't always mean the trend is reversing. Sometimes that lower time frame shift is just price moving to fill an imbalance on the higher time frame. This is the moment where most traders panic. They think the trend has turned against them. Lower time frame structure must always be read in the context of the higher time frame. Without this context, lower time frame signals will mislead you every time. This is why many traders lose money. They see a break on a lower time frame and trade against the higher time frame trend. It's not that they're wrong, they're just early and out of context. So here is the simple rule to use. First, define the higher time frame bias. Then use the lower time frame only to find interest, not to define direction. Now that you understand how higher time frame and lower time frame trends interact, the next step is combining market structure with ICT concepts like liquidity and point of interest. This is where things get really powerful. Now that we know market structure, higher time frame versus lower time frame trends, and how to read pullbacks, it's time to combine this with ICT concepts. This is where trading starts to make real sense. Market structure tells us the overall direction of price, whether bullish, bearish, or ranging. Liquidity explains why price moves, where stops, orders, and smart money interests are concentrated. When you combine them, you understand not just where price is going, but why it's moving in that direction. This makes your entries and exits more predictable and logical. If you want to know more about liquidity, check out my last video. Points of interest are zones where smart money left footprints, like order block, fair value gaps, or imbalances. When you align these zones with the market structure, you see areas where price is likely to pause, reverse, or accelerate. By focusing on these points, you reduce guesswork and trade with the higher time frame trend instead of against it. Many beginners make three big mistakes. The first one is trading points of interest against the higher time frame trend. The second one is ignoring liquidity and expecting price to reverse perfectly at a zone. The third one is complicating by looking at too many zones at once. The rule is simple. Higher time frame trend defines direction, lower time frame shows interest, points of interest confirms, and liquidity explains the move. Always start with the higher time frame bias, then check the lower time frame for structure, confirm with points of interest and liquidity, and enter with confidence. Master this and trading becomes much less confusing. If this video helped you understand market structure clearly, smash the like button, subscribe for more trading content, and drop a comment with your biggest takeaway. I'd love to hear what clicks for you. Let's level up our trading together.